Welcome to Spidell's California Minute. I'm your host, Catherine Zidane, and this week we're covering the pass-through entity tax enacted by AB 150 and how it interacts with non-resident withholding. Before we start, we had a really successful fundraising drive to benefit the Salvation Army's anti-human trafficking Safe Home. So thank you from everyone at Spidell to all of those who listened to the fundraiser podcast and to all the new podcast subscribers that joined during September. As taxpayers consider the benefits and potential drawbacks to California's new pass-through entity tax, which is a workaround for the federal $10,000 state and local tax limitation for qualifying S-corporation, partnership, and LLC owners, we continue to work with the FTB to get answers to your questions. One recent issue the FTB addressed is how the credit affects non-resident withholding. For the 2021 through 2025 taxable years, a qualified S-corporation, partnership, or LLC taxed as a partnership, or S-corporation that's doing business in California and is required to file a California return, can elect to pay a pass-through entity tax equal to 9.3% on its qualified net income. This will decrease the federal net income included on the owner's K-1. This allows the K-1 recipient to reduce federal AGI rather than having a state tax deduction on Schedule A, which would be subject to the $10,000 state and local tax deduction limit. The owner will report the net income to California, which will not include the tax payment, and will also receive a California tax credit equal to the state tax paid by the pass-through entity on behalf of the owner. But here's the rub. California also requires withholding at a rate of 7% on taxable distributions made to non-residents if total distributions are $1,500 or more. Unfortunately, there's no provision that would reduce the non-resident withholding required for distributions to non-residents who consent to having the pass-through entity tax paid on their behalf. This means that if an entity and the non-resident shareholder, partner, or member elects to pay the pass-through entity tax and the entity distributed all of its net income, the non-resident owner would essentially pay 16.3% in withholding to California on that income, which would be the 7% non-resident withholding plus the 9.3% pass-through entity tax. At this point, there's no special mechanism for the taxpayers to request reduced withholding or a withholding exemption to reflect the pass-through entity tax for 2021. Certain taxpayers can apply for a waiver if the taxpayer is subject to non-resident withholding due to California source income being distributed. For example, a taxpayer who filed the prior 2 years' returns can file FTB Form 588 to request a waiver from withholding, or FTB Form 589 to request a reduced withholding amount. At this point, we don't believe the FTB will allow a taxpayer to use Forms 588 or 589 to reduce non-resident withholding due to the payment of the 9.3% pass-through entity tax. But this is one of the questions we've asked the FTB. We continue to work with the FTB to get answers to the multitude of questions about AB 150. Tune in to the next session of Spidell's quarterly tax update webinar on October 19th, where Renee Rado will fill you in on the latest information we have. That's all for this week. Join us next time for another episode of Spidell's California Minute.